Speaking and analyzing internal control, it is an appropriate point to clarify both the definition and the functions of external audit. Only then will the differences between internal and external audit become clear. To begin with, external audit is a systematic work carried out by an independent and professionally qualified auditor. With this work, the auditor achieves the collection and evaluation of items which will allow him to form an opinion on the reliability of the financial statements. The purpose of the external auditor is to establish the reliability of management's assertions regarding the quality, completeness, legality, and consistency of the accounting information provided. In order to achieve this, the external auditor carries out systematic and methodical procedures. Once the audit process has been carried out, the auditor records his opinion on the reliability of the accounting statements. This entry is made in the audit report and submitted to the board of directors of the company and in the audit certificate, where it is submitted to the board of directors and the general meeting of shareholders. The report is highly confidential, unlike the audit certificate, which is published together with the accounts. Let's move on to the importance and relevance of the external audit. Porter, Simon, and Hatherley raised three key questions. The main reason was to show the importance of external auditors in auditing financial statements. The questions were as follows. Why is the information in the financial statements not reliable? Why is it so important for recipients of the financial statements the information presented in the financial statements to be reliable? Why do users of financial statements not check this information themselves? The answers to the three questions are summarized in the following four factors. The following four factors are so provided in the answer to the question why external auditor is necessary. First, conflict of interest. There are company managements who undertake the preparation of the financial statements and are likely to try to present a more embellished picture of their business than the real one. On the other hand, there are shareholders, banks, and other lenders who are interested in knowing the true state of the companies because they have interests and assets at stake. Then we have consequence of errors. Users of financial statements base their investment decisions on the information in the financial statements. It is therefore obvious that they are not prepared to risk making decisions on false or incorrect information. Then there is distance. Users of financial statements do not have the ability to be inside the enterprise at all times to be able to verify the reliability of the information provided in the financial statements. And the last reason is the complexity. As the size of business grows, so does the volume of transactions. Particularly in recent years, both the transactions and the accounting systems that manage them have increased in complexity. This means that there are many increased opportunities for errors to be committed, and consequently, the users of financial statements lack the necessary knowledge to assess and trust the validity of the information provided to them. In summary, it can rightly be said that external audit contributes to the proper functioning of the company and to ensuring a good image vis-a-vis shareholders and the investing public. In addition, according to Porter, Simon, and Heatherly, the external auditor is a complete knowledge of the financial situation of a company and is independent of an objective towards the management. Therefore, it can judge and advise management on issues of improving internal control, developing accounting information systems, and give tax, investment, and financial advice. Now let's see the external audit items. The external audit, depending on the element it chooses to emphasize, can be divided into 5 types of audit. First is the financial audits. A financial audit is an audit to ascertain the fair presentation in the financial statements of the economic data relating to the financial position and the results of operation of economic units. Efficiency checks. An efficient audit is designed to test the process or function in an organization to determine how positive it is for the organization. Then we have operational audit. Operation auditing seeks to assess whether a function is performed in accordance with ethical or scientific criteria and principles of the particular industry and in accordance with general business and management principles. Then there is compliance audit. Compliance audit aims to establish compliance with some pre-agreed conditions or prescribed procedures of the parties involved, for example, compliance with the terms of loan agreements. And last is specific audits. Any audit which doesn't fall into one of the above specific categories may be considered a specific audit, provided of course that the auditor is able to carry out the specific audit.